Good morning, and thanks for joining us for another Tecnoglass call so we can report Q3 results. We had a strong Q3 with revenues growing organically in the mid-single digits area at 4.5%. That was driven by our continued growth in backlog, with the commercial construction segment growing about 6%, and being able to hit an all-time high revenue quarter for the single-family residential segment at 87.8 million. And up sequentially as well. From a cash flow perspective, we were able to achieve a record operating cash flow of 51.2 million for the quarter, and obviously we were able to reinvest in the growth and returning cash to shareholders, as we'll discuss farther along the line. Adjusted EBITDA at 71.3% continues to be at an industry-leading margin type company. This quarter was impacted by a non-cash FX on inventory, which we'll discuss farther along the line when I touch on gross margin performance. We have different other strategic initiatives that we reported throughout the quarter, mainly our entrance into the vinyl window segment, which opens up a lot of opportunities for the company, more than doubling our addressable market. We changed our headquarters now into Miami, Florida, which is aligned with our strategy to continue penetrating the US and becoming more and more of a US-centric company. And we started and executed on about 40% of our buyback program. Moving on to backlog, this is a reiterating story of backlog growth, now growing 20% year over year versus Q3 of 2022. Despite all of the challenges out there from a macroeconomic perspective, we continue to see backlog growth, and some projects that were previously put on hold are moving forward with the operations, and we continue to capture a lot of that market in regions that are enjoying better demographic and secular trends than some other places in the US. As we have discussed in previous calls, the backlog does not include any single-family residential business. So at the end of the day, the backlog is underrepresented because it only covers 60% of our overall revenue stream, which is related to the commercial segment. We wanted to highlight backlog conversion and show everyone how the backlog is a very good indicator and provides a lot of strong visibility over the following 18 months after reporting the backlog. Essentially, if you look at the graph, what happens is that after reporting backlog, roughly 2/3 of that backlog is invoiced over the following 12 months, and the remaining 1/3 is invoiced over months 12 to 18. So essentially, it's a one-to-one correlation that leads you to have very good visibility over the following 18 months of revenues on the commercial side. So with that said, what we're reporting right now leads you to believe that 2024 is already pretty much spoken for, and now building into 2025. Moving on into the residential segment, we touched into some of the avenues for growth that we're seeing going forward. Number one, the geographical expansion that we've undertaken with setting up showrooms in different places throughout the US. 2 of them already operational in New York and Charleston. 2 more to be done by year end in Houston and Florida, with the intention of opening 2 or 3 more next year. So we're seeing that should generate incremental avenues for organic growth, which go hand in hand with the entrance into the vinyl segment, which accounts for roughly 60% of the total addressable market. So more than doubles the opportunity that we have currently just by doing aluminum windows. This is a very large segment, and it aligns perfectly with the initiative to expand geographically, given the fact that many other places outside of Florida in the US are more vinyl-driven than aluminum-driven. So that continues to be something to look out for. We already have 2 lines that are ready for production starting next week, with a 3rd line that will be coming at the end of November. So the first deliveries will already take place in December, and we expect this to contribute in a more meaningful way in 2024. From a revenue perspective, moving on, we already discussed mid-single digit growth year over year. Both segments contributed in this quarter, with residential hitting an all-time high at 87.8. A lot of it is repair and remodeling, as we've discussed in the past. Obviously, with high interest rates, new construction continues to be challenged. Moving on to adjusted EBITDA, I mentioned earlier that we were impacted by a non-cash FX impact this quarter, which was mainly related to a sharp and fast revaluation of the peso. So the peso strengthened from Q2 to Q3, and being the fact that our functional currency is the Colombian peso, inventories get booked as spot prices. In other words, they got booked when the peso was devaluated in Q2, but then when they flow through the P&L in Q3 at a much stronger peso, that means more dollars going through COGS. So it creates an impact, whereas margins are partially challenged, but at the end of the day, it's a non-cash effect because both the inventory and the sale take place in dollars, right? So it's more of an accounting issue rather than a cash flow issue. From a cash flow perspective, and in line with what I just mentioned, we were able to record an all-time high operating cash flow quarter at $51 million. CapEx is almost completed. We completed investments to, reach production of up to $1 billion. So we have a lot of runway to grow into, and that has provided a lot of financial flexibility with, more than $170 million in lines available to us, plus $120 million more or less in cash that we ended up the quarter with. Being that the CapEx is mostly completed, we were able to start executing on the buyback that we had previously announced by the board and executed 40% of the $50 million program that was announced. So $30 million is still available under that program. Moving on, from a returns perspective, we continue to almost double the industry with returns on equity north of 30% versus about 15% for the industry, and a return on invested capital at 18% versus 8% or so. So we'll continue to find avenues to return cash to shareholders, but more importantly, to grow operations in a very profitable way. Finally, based on the year-to-date results, we're updating our 2023 guidance. We're now seeing revenues at a range between $835 to $848 million, which end up being about 18% at the midpoint year over year, all organic growth. We're also adjusting adjusted EBITDA to a range between $300 to $308 million, which equates to about a 14.5% year over year growth, also all organic. These ranges are also updated based on Q3 results and the fact that some of the projects from Q4 are actually delaying and moving into 2024. This gives us even more confidence that 2024 will be a double-digit growth rate from a top-line perspective against 2023. So more to come when we report in Q4, as we'll provide more details. Thanks again for joining.